In the Middle East, the conflict has escalated far beyond regional borders. Israel and Iran are targeting each other's gas and energy facilities. Historically, there is a clear playbook for this scenario. When war threatens global energy supplies, investors move their capital into safe haven assets. This is why physical commodities like gold and silver usually see their prices increase during conflict. But this chart shows the opposite is happening. While geopolitical conflict alerts climb, the prices for both gold and silver are dropping sharply. Major banking equities are also losing billions in market capitalization overnight. The markets are reacting in direct contradiction to standard economic theory. During a global crisis, these traditional safe havens are seeing heavy selling pressure. The divergence between paper prices and physical demand suggests that the market is pricing a digital liquidation rather than the long-term value of the metal. Attacks on major gas fields immediately threaten the global supply chain. If energy infrastructure is severely damaged, the world faces an abrupt oil shortage. When oil is scarce, the cost to transport goods and manufacture products stays high. This causes inflation to remain sticky, meaning prices do not come down for everyday consumers. To fight that persistent inflation, the U.S. Federal Reserve relies on a hawkish pause. They refuse to cut interest rates, keeping borrowing costs intentionally high to cool off the economy. High interest rates pull capital out of commodities and into yield-bearing assets, strengthening the U.S. dollar. That stronger dollar creates the initial downward pressure on the price of gold and silver. That downward pressure trickles into the derivatives market, specifically targeting paper silver. Retail investors often buy leveraged exchange-traded funds, or ETFs, which are investment funds traded on stock exchanges, meaning they hold digital promises, not physical metal. Because these investors use borrowed money to buy those ETFs, a slight dip in the paper price triggers a margin call. A margin call is a broker's demand for an investor to deposit more cash immediately to cover potential losses. If they cannot, algorithms sell their positions automatically. This flowchart maps the feedback loop. A price drop triggers a margin call, forcing liquidation, pushing the price lower and triggering more margin calls. Within days, traders offloaded over $3 billion in paper futures. The contract volume grew too heavy to sustain. During that multi-billion-dollar sell-off, no physical silver actually moved out of a vault to satisfy a trade. The crash occurred strictly within the digital market. It was a digital shakeout that liquidated accounts of traders using too much leverage. While retail traders sell their paper positions at a loss, institutions and central banks are executing a different strategy. Major players like JP Morgan are taking delivery of millions of ounces of actual, tangible metal, draining physical vaults while paper prices remain low. This bar chart comparing mining output against global industrial demand reveals a supply deficit. For the last 6 years, the world has consumed more silver than it pulls out of the ground. Extracting physical metal requires moving millions of tons of earth. The entire mining process relies on a continuous consumption of diesel fuel and electricity. When geopolitical conflicts restrict major oil routes, the cost of fuel rises. That directly increases the operating cost to extract each ounce of silver. Extraction costs are rising and global vaults are draining, yet the paper price continues to drop. This confirms the widening gap between digital trading and physical reality. This scale visualization illustrates a fractional reserve system, a financial structure where institutions hold hundreds of paper claims for every 1 ounce of real metal stored in a vault. The paper crash creates an environment where institutional players can accumulate hard, physical assets while retail investors sell out of fear. Industrial manufacturing cannot use a paper futures contract to build a solar panel, an AI data center, or a military missile. These sectors require the actual element. If industrial buyers demand physical delivery from empty vaults, the price of the metal will have to adjust to reflect actual physical scarcity. For long-term investors, the focus remains on tracking the physical accumulation of metal by large institutions, rather than the daily digital price movement. A market built on paper promises can hide supply deficits for a time, but the physical cost of production and actual availability will determine the ultimate value.